Thank you so much, Kathy. We're glad to be here with you all today to talk about the 351 exchange, which we're going to talk taxes, folks. So it's going to be riveting. We're going to try and keep it interesting. I think actually this is a very, very interesting and important topic right now. With the growth that we've had in markets in the last, actually quite a long time now, tax strategy has become even more important with low cost basis positions in people's portfolios having achieved massive growth, in some cases over the last 15 years or more. So this strategy, we'll get into all the nitty gritty of it and set up with a little bit of context about where we are in the market right now. Um, is so important because it allows one to take part of a portfolio and change the allocation into the launch of a new ETF without paying taxes on a sale of those assets. So it's basically just a transfer, but it has to be into the first day launch of a new ETF. So there's your little teaser on what it's going to be. And we're going to do a little setup on why we think this is particularly important right now, and then we'll get into the nuts and bolts of it. Phil, would you like to add anything to that?
Yeah, I would. I just wanted to say a little bit about who we are. We are a asset management firm that specializes in both hedged equity and what we call adaptive fixed income. And we do have an ETF complex and mutual fund complex. And one of the reasons we're talking about this is that we saw an opportunity at our firm to actually execute on 351 exchanges. So we have targeted launch planned for some products that you can 351 exchange into. So that means we potentially allow you to leave the theoretical into the actual world with this idea. So Eben, I'll let you, the master of the 351 exchange, continue.
Thank you. All right, let's get it going here. All right. Unlock appreciated gains and deferred taxes. That's what we're going to talk about. And I think it's, one of the big challenges right now that I think everyone is facing when you've got clients who have been in the S&P, NASDAQ, just, the Mag 7, the gains that they've had are so incredible that in many cases they have become outsized portions of their portfolio. And now their risk tolerance, there's been risk drift, right? Their risk tolerance is no longer in line with the risk of their portfolio, especially in heady markets like we may have right now. And so let's talk a little bit about where we are right now. This is essentially my entire lifetime of the NASDAQ plus a couple months. And when you look at a graph like this, you just sort of see like obvious up and to the right, but some of the things that maybe don't register as much because it's a logarithmic scale are the NASDAQ took a 64% drop like right out of the gate. Like the NASDAQ launched as an index and then dropped 64%. In the 2000s, 80-ish percent drop. They don't look that significant on the drop, as well as innumerable, 25% declines. They don't look as significant on here, but if you've been around for a while, you remember how punishing and terrifying these events can be. And I think now is a time for people to reevaluate where we are. Could markets double from here? Absolutely. Could they be cut in half? Absolutely. Will we know in advance? Absolutely not. So to take some of the profits that clients have achieved and have been lucky enough to be investors through these last several years and diversify them into new strategies and not have to take the tax hit when doing so, we think is a massive opportunity. Want to add anything, Phil?
Only, and I think that maybe you talk about this in the next slides. So I'm lucky enough to, we're just about 20 minutes by subway from Bloomberg News, and I'm lucky enough to be on Bloomberg TV and radio. And my favorite guys are Tom Keene from Bloomberg Radio. And so, as I mentioned before, we're a specialist in hedged equity. And every time over the past 5 years when I've talked about hedged equity, Tom Keene asks, so what am I supposed to do? Sell my meta and pay taxes and go to hedged equity? And I'm like, so it's painful because if what you were saying earlier is that if you have these appreciated positions, No one really wants to just say, I'm going to take the 20% loss. Right? That's a really hard decision to make. And I'm going to reframe it just slightly. And this is not resonating very well, but even if it's not a concentrated position, even if you're just in things like the triple Qs or anything, you've got some amazing gains that you might want to try to limit losses from, and you don't want to pay the taxes on that either. So it's a real question. I think that's why that explains why you're really excited about this tax code, Evan.
Yeah,
It essentially solves that problem.
and nobody thinks of their portfolio value minus the taxes, right? That's how much money they have. They don't think I have that much money plus what Uncle Sam takes. And these drawdown periods that I illustrated with the 64% right out of the gate when I was in diapers, and then the 80%, which it took 15 years to come back to zero. I mean, I think I recently mentioned to you, Phil, well, I said something about like the dot-com being not that long ago. It's actually a long time ago now. It's a long time ago. We've just been doing this a while. And so a lot of people either don't know or they've just absolutely forgotten that the NASDAQ was down 80% and took 15 years just to come back to zero. That is really hard to imagine at this point. However, we've seen these elevated places before in the market and what can happen from there.
Additional evidence of your age. Even the financial crisis now is off the 15-year return chart. So if you look at Morningstar ratings from Morning for funds, they only go up to 15 years. There's no evidence of financial crisis as a part of that. So anyway,
Yeah. And if I were hiring an attorney that had 15 years of experience, I would think, all right, this attorney has a lot of experience. A financial advisor who only has 15 years of experience has had a really killer run. It's been amazing. They haven't, other than being students of the market, which most people in this industry are, they haven't experienced the feeling of what it feels like to, to have experienced those insane declines that, we've been through. Another thing is the concentration in the market. So if you look at this blue line here, we're actually even, about this spot now in terms of concentration, where we have not been since 1970. And the Mag 7 of 1970 was the Nifty 50, which sounds very 1970. And the thing there was buy at any price. That was the sort of slogan of the Nifty 50. And only five of those 50 companies are still in the S&P. And kind of funny, they are healthcare and junk food, sort of the perfect cycle there. And about half those companies don't even exist anymore. So it's interesting when one looks at concentration and how that naturally disseminates back into a broader spectrum from there. So we're at elevated concentration, we're at elevated valuations, and while we're not making any market calls, we do believe that it is a good time to diversify what one has, and here's a unique opportunity to do that. So let's get into talking about who the 351 exchange is for. People with embedded gains. So it is folks who have been in the market for a while. They may have been smart or lucky to have gotten into the Mag 7 or other stocks early, and they either want or need to reallocate. So maybe they've gotten older and they're in that sort of red zone around retirement or in retirement, and their portfolio is too much Mag 7 for their age or their just general demeanor. Um, they may have custom indexing products that have ossified where all the tax losses have been harvested. What do you do with that? And then I think this defines most people are tax avoidant. There aren't that many people. One does have the option to contribute more on their taxes. I would love to know the number of people that do that. I bet it is a very, very small number. So
real
you've got
patriots,
real
real.
patriots. Apparently, we're not real patriots.
Okay.
We're trying to help you to be less patriotic, maybe. I don't know.
Great.
You've got the embedded gains, you want or need to reallocate, and you don't want to pay taxes on that. So let's talk about some of the challenges of a 351 exchange. I think that's always important to look at. All right, what's hard about this? So first of all, there's getting used to how a 351 exchange works. There have been several different 351 exchanges done, which I'll get into the two different kinds in a bit. But there is that challenge of like, okay, this is a new tax code to me, you, that is. Um, so you have to learn what all the parts of it are and how it functions. It's not a particularly heavy lift from the advisor side, other than getting a couple signatures, which maybe is a maybe it's not fair to say that's not a heavy lift. You have to get a couple of client signatures, and I know that can be a challenge. And then you're going into the first day of a new ETF. So literally this only works on day one of a new ETF. On day two and forevermore, the ETF is just a regular old ETF, and you no longer have the chance to do this 351 exchange. Now, why was it created is always an interesting thought, right? Because this was not created for ETFs. It was created essentially to eliminate tax friction for entrepreneurs. So let's say you've got a company, that company owns a warehouse. And this is very hypothetical about why it was created in the 50s. The company owns a warehouse. The warehouse they bought for $1 million, it's now worth $2 million. You've got $1 million of gains there. Now, that company, that first company, decides to create the Kelly Motor Company, and they want to transfer that warehouse for Kelly Motor Company's use. So they're not selling it and buying it. They own both of these companies. So what they're doing is they're transferring that warehouse in exchange for $1 million worth of Kelly Motor Company stock. It's not a sale and repurchase. One company owns both. They transfer the stock of that second company in exchange for the warehouse at $1 million, not two. So they're carrying the cost basis there. It's still $1 million. They would have to pay the $1 million in taxes if they were to sell it, but they're not selling it. They're able to transfer it. Now let's talk about the two different kinds of 351 exchanges. The one that has been around a little bit longer, and there have been more of these done, is if, let's say, you're a $1 billion RIA and you have 10 different portfolios, and each one of them has $100 million in it. You could launch 10 different ETFs, one for each of those, capital preservation through, aggressive growth, and roll that $100 million in each of those into the new ETF. So that's a 351 exchange. You're just taking the portfolio and rolling it into an ETF. It would be operationally more efficient and more tax efficient because you would be able to change allocations through the create and redeem process rather than selling and buying. So that initially is what 351 exchanges are for. Now, there's the syndicated 351 exchange, which is what we're going to talk about mostly today because I think it's going to be applicable for more people, where an ETF issuer has, unless you're, BlackRock or something, launching an ETF, there's always a challenge of seeding it. So this is sort of the symbiotic relationship where an ETF issuer like us goes to different RIAs, and those RIAs who have clients with low cost bases who want to participate in a 351 exchange are able to. And so you're going out to multiple RIAs, to multiple clients to see the ETF. And essentially, that symbiotic part is the client gets to change an allocation without the tax hit. So that syndicated 351 exchange, is that symbiotic relationship. So let's talk about a couple of the requirements. It is only an exchange of individual stocks for an ETF, for shares of a new ETF. So a portion of someone's portfolio of stocks and ETFs can be transferred for shares of the new ETF. On the first day, when the 351 exchange is effective, the first day of that ETF's life, the 351 exchange contributors need to control 80% of that ETF, which is not an issue. because most people are not having to turn away money on the day one launch. And you just sort of essentially soft launch it, and the second day is when people become aware of it. And then third, it's diversified to diversified. So you're taking a portion of a diversified portfolio and contributing it to a new ETF. So that means you can't just take one position. You can't just take your NVIDIA and contribute it to the new ETF. And that ETF will likely have multiple positions in it. They structure, generally people structure them pretty broadly per the prospectus so they can accept, more than just a couple of things. The idea of being able to sort of shield one's wealth from taxes in this way is I think really interesting. And it bears repeating that as a tax deferral, it is not a resetting of cost basis. It is carrying the cost basis to the ownership of the new ETF. And one has the choice and should have the conversation with their tax consultant about whether to own, you're taking your diversified portfolio, and now you have all these things, and now you have one thing, just the new ETF. So do you average the cost basis of your existing portfolio for the ownership of the new ETF, or do you own the new ETF at multiple cost bases based on the dollar amount of the contributed assets? Either way works. It's a conversation to have with your tax consultant. Again, the cost basis is transferred. The holding period is also carried over. So on the second day or third day or 10th day, you have long-term gains, assuming you had long-term gains before. Even though you've only owned this new ETF for a day or five, you have long-term gains. So let's talk about what it's not. Often exchange funds and 351 exchanges get confused. So let's just spend a couple minutes differentiating the two. An exchange fund, one can take a single position and mingle it with the other positions in that exchange fund, which are generally, the sort of expected Mag 7 and other highly appreciated assets. And that will help you with the idiosyncratic risk of your single position, but you're getting mingled in with all of these other ones that, because it's a private investment, you may not have total sight into what those positions are, which is, and you're going to get a K1. It's a closed investment. So it's a different thing. Whereas a 351 exchange is just going into an ETF and all the liquidity and transparency of an ETF. With an exchange fund, you generally have a 7-year lockup, and then there's limited liquidity even after that lockup has passed, and there can be penalties for early withdrawal. And with a 351 exchange, again, it's just an ETF. So if on the second day your client's like, you know what, I need to buy a Ferrari, I need money, you can sell it and pay the taxes and, get that money for their Ferrari. Exchange funds tend to have pretty high fees, and ETFs, one of the reasons many people like them is because they generally have lower fees, and there would be no early withdrawal fees, again, because it's just an ETF. Exchange funds have a curious feature, I guess. To avoid being classified as an investment company, they have to hold 20% in qualified illiquid assets. So it could be gold or silver or real estate. And I think all of the cases they've settled on real estate as the 20%. So you've got a bunch of other things you may not have total clarity on what they are, and 20% real estate. And an exchange fund, it's determined, I mean, it's dictated by the prospectus what you're getting into and what it's going to do. So you can always just see what it is there. And lastly, an exchange fund has the benefit of going from concentrated, that single NVIDIA position, into diversified. With a 351 exchange, it has to be diversified to diversified. And I will get into what that is, what the rules on that are. But as I was saying, you're taking care of the idiosyncratic risk of taking your NVIDIA position and going to an exchange fund. But you can take a small group of stocks and diversify out of that idiosyncratic risk of those, as well as the systemic risk of being in an exchange fund or being in an index, because you could go into something like what we do which is hedged with option strategies. So let's talk about the 25-50 rule. And this is an important one. I mean, if you were to take nothing away from this other than understanding the 25-50 rule, you would have a leg up on all of your competitors out there. And I think that's actually a really important point. Many of the advisors that we've talked to about this are really excited about it because other RIAs don't know about it. And so when competing for a new business, and you can see that they've got concentrated positions or low cost basis positions, this is something that you will be able to offer that most of your competitors will not know about. So let's talk about the 25 part of the 25-50 requirement. So the 25% is the max you can have in any one issuer. So you can transfer 25% of NVIDIA, but then you need 75% of other things. Now you see here that I've got an ETF as the other 75%, which doesn't really make sense because ETFs are one thing. However, there is a look through on ETFs. So if we're talking about NVIDIA for 25% and QQQ, that counts as 100 stocks. And SPY or whatever would count as 500. So it's a look through. Now there's another however to that, which is that it's 25% max issuer in the whole portfolio. And in our NVIDIA example, the NASDAQ 100 is, I believe, 11% NVIDIA. So we can help you with that math to make sure that you don't go over the 25-50 requirement there, or the 25 in this part. You could also have two ETFs, or two stocks rather, at 20% and the rest in an ETF. And again, these two positions would have to be balanced out in any participation that they have in the ETF in this portion of it for overlap. Now, the 50% part of it is that the top five positions can't be more than 50% of the portfolio. You could just have one ETF on the other 50%, but that top five positions can't be more than 50. So you can have 9.9% of NVIDIA, Tesla, Microsoft, Broadcom, and who am I forgetting? Somebody fun.
That's just did you say Alphabet?
Alphabet, thank you.
There you go.
I
Okay.
knew I was missing a big one there. And then, the ETF for the rest of it. Or it can just be a rainbow of different stocks and ETFs over on the other side. Now, an important part of this is it can only be stocks and ETFs. No mutual funds, no crypto, no commodities, no REITs, only ETFs and mutual funds. And we can create bespoke ETFs for you if you've got big models that you want to roll into an ETF to simplify your life. Let's talk a little bit about the tax treatment now, because I think that bears a couple of minutes of consideration. So let's say here's your portfolio. You've got 20% allocation in stock A, 10% in stock B, 10 in ETF A and B, and then a bunch of other stocks and ETFs over here. So this is the portfolio you are contributing. Now let's look at stock A, for instance. It was purchased at two different times. So it's got a different cost basis per share. It's got a different total cost basis, different gains, but each allocation is $100,000. Same with stock B, purchased at two different times with a different cost basis per share and total cost basis. Now, oops, this is important because you will have to discuss with the tax consultant how you want to contribute and which tax lots you want to contribute. The lower cost basis ones most likely. So we're starting with this portfolio, and now you're going into the ownership of just one ETF, but at multiple cost bases, or again, an average. This could just be, ownership of the new ETF at the single average cost basis or the multiple cost bases. So let's look. Okay, now you own the new ETF at all these multiple cost bases, hypothetical $20 initial share price. Now it's still 10% of the $1 million. It's still 100,000 each of these purchases. The cost basis is still the same for each. The total gain is still the same, but you've got a different number of shares and a different cost basis per share with the hypothetical $20 initial share price of the new ETF.
Evan,
So
I want to point out something that probably most advisors on the line realize is that you can actually use this to sort of effectively sell out of highly appreciated positions if you combine highly appreciated positions with other, let's say, ETFs that don't have much in gains. Move everything in the ETF, and then when you sell the ETF, you could come out of the low or no gain positions. So effectively, you're able to kind of move out of those stocks in a way where otherwise you wouldn't. So so anyway.
yeah, I think that's a good point. In a most people have that one stock that's sort of like the nail sticking out of the board. And in order to sort of pad it, if you will, one can take either cash or neutral cost basis positions and buy an ETF to, pad the other 75% around that single position. Thanks for pointing that out, Phil. Okay. Now this is preposterously small, and I apologize for that. But this is the report that we would generate after doing the 2550 math for you. This is a little closer up of the contributed pieces. But as a place to start, if you're like, you know what, I think this would work for the Smiths. They have some low cost basis positions. It would benefit them to diversify a little bit and hedge a portion of their portfolio. You would just take the Schwab download or whatever and send it to us without any personal information on it, obviously, and tell us, okay, out of this $10 million portfolio, I want to do $2 million and I want to get rid of the most NVIDIA. And after that, Apple, Microsoft, and Broadcom. And we would then do the 2550 math for you. And maybe you don't know exactly what the dollar amount is you want to contribute, and we can just sort of max it and say, okay, here's the max that you could do. It's $4 million and still meet the 2550 requirements. And then you can say, okay, I only want to do two, but then we have the opportunity to sort of dial things up and down. They're not really excited about Apple, so let's get rid of more of that. And they're kind of bullish on Tesla, so let's dial that back a little bit. So it's an iterative process that starts with just sending Schwab is sort of the most advanced with this process. So sending their Schwab download, and then we would just have a couple of 10-minute phone calls to look at it and say, okay, bring this one up, bring this one down. And in this case, the total unrealized gains deferred 5.6 million out of the total contribution 9.9 there. And it passes the single issuer test with 4.7 max at 4.7 each, and the single issuer at 4.7, and the 50 of the 2550 at 23.8. Now, the mechanics of it. As I said, it's not a particularly heavy lift. The starting place is looking at the portfolio, having us do the 2550 math, which over the time period until the launch of the ETF, we will do multiple times to make sure that it stays within those bounds, because probably the stocks that are being contributed are more volatile than your, sort of boring stocks. And once we've done the sort of iterative process and come up with a portfolio and a dollar amount that seems like it would benefit your clients, they would sign a letter of authorization, which is not even a page. It's basically name, account number, our name, our account number, saying, hey, Schwab or whoever, we want to do this. Nearly nothing on that thing. Then we would look at the month-end brokerage statements showing the tax lots being contributed, and then exactly which tax lots are being contributed. So which tax lots of your NVIDIA position are being contributed. And then there's the contribution agreement, which is the contract between us and the contributor. So Pershing, Schwab, Altruist, JP Morgan, Goldman on the custody side, SEI, AssetMark, everybody knows what this is and knows how to do it to greater or lesser degrees. Fidelity has temporarily put a pause on it. They were doing it at a more onerous fashion than the other custodians. So I don't know when they're going to or if they're going to restart it, but um, they put a temporary pause on it. Just to get a little more detail on the letter of authorization versus the contribution agreement, letter of authorization is just instructional. And the contribution is the legal agreement saying you're going to contribute these assets, we're going to give you these shares of the ETF. The letter of authorization not binding, and yes, this is a contract between us, with the rights, obligations, and representations. The client is the only person that signs the letter of authorization, and the issuer and the contributor both sign the contribution agreement. Now, when you launch a new ETF via a 351 exchange, you're having different things put in the top of the funnel here that must meet the prospectus of the new ETF. So for instance, with our hedged NASDAQ strategy or hedged S&P strategies that we're launching, we can't take a muni fund, right? They either have to be, in the case of the hedged NASDAQ, they have to be NASDAQ 100 constituents or ETFs with significant overlap with the NASDAQ, and the same with the hedged S&P. And at the launch of a new ETF via a 351 exchange, and this is for anybody launching one new one, it will not exactly match the index that that issuer is trying to replicate. Because, for instance, with the NASDAQ, we're going to get more Apple, we're going to get more of the Mag 7 than the other 93, right? That's just sort of stands to reason that people have more of those. They would like to get rid of them. Now, in a case like ours, where we're going to be hedging it, we're going to be very conservative about what we accept because we want to be able to hedge it as effectively as possible, as quickly as possible, and as precisely as possible. So if we get a bunch of people coming in with positions in NVIDIA, we're going to say, okay, no more NVIDIA, because we want to be able to make sure that we can do this effectively as quickly as possible.
I don't know,
Now,
maybe it's worth talking a little bit about because for advisors contemplating this, the logistics that you're talking about and the sort of the tax configurations that you're doing a great job of explaining are very important. And then equally important for any advisor or investor that's considering this is where it lands. Because obviously, if you're coming into something with gains, to get out of it, and you'll be talking about that in a minute, you don't really want to pay taxes to come out of it. So you're going to want to live there for a while. And so what we've seen a lot of what you talked about where RIAs are doing their own 3-to-1 exchanges over the last years. And what's relatively new is the idea of a syndicated ETF exchange where multiple advisors are joining and partnering up with an ETF issuer. So just in the last 12 months or so, there have been a number of these syndicated ETF launches. The biggest one that was launched in just a couple of months ago was a $200 million initial 351 exchange seed. But what's been happening so far for everyone is they've been launching just a passive index. So, for example, a global equal weight. And so what the reason we got into this space is that we wanted to launch something that would provide an additional component, an additional characteristic other than just the ability to diversify. So in the case of our 351 exchanges, and you may or may not be interested in this version, is we're introducing a hedge. So, as you pointed out, the two products that have already cleared through the SEC pathways are a hedged NASDAQ and a hedged cap weight S&P ETF. So those are two things we're looking to do. And those are ultimately designed to look like the indices. But and as you point out, initially they won't look exactly like the index because things are going to come in that we can't immediately sell and move over. We are thinking and seriously, and we do plan to bring in some additional assets from our SMAs to help balance it out right away. But just so you have an idea, what does that mean, a hedged equity ETF? In the most broad terms possible, that looks like a target 70 to 75% up capture of the index, and a 50% down capture in the case of the S&P, maybe even less if you get into a crisis market in terms of down capture. So I wanted to point that out since you're talking about this target allocation now. Hopefully I haven't preempted a slide where you're already going to say that, Evan. So
No, that's great.
sort
That's
of,
great. And if you're interested, throw your email address or your phone number in the chat and we can, or the Q&A, and we can
right,
get
right.
back to you. Um, so to Phil's point about once you've done a 351 exchange and you are in the new ETF, yes, you absolutely have the ability to sell it and pay taxes. You can also die and get a step up. Lastly, you can do a 351 exchange into another ETF. So the thought that you are trapped, in quotes, in the new ETF is not accurate, though you would want to spend the time with the new firm to understand the trading process, to understand who they are. Have they been doing this a long time? Is this their expertise? Do you mind talking to them on the phone, right? Are they annoying? Basically, do you trust them? And so that is the sort of second biggest part of this. It's understanding the 351 exchange part. Do you want the product? Is this the firm to launch the product? We have the experience of over 30 years of running strategies like this, so I feel very confident in what we're launching. There is a timeline to this, though. As we've said, it's only good on the first day of the launch. So really, for indications of interest, really any time after the ETF is effective, you can give indications of interest. One needs to sign documents a month to 3 weeks in advance, and that actually can take a while, as you know, getting clients to sign things and making sure they've discussed it with their tax consultant, if that's not also you. And then a week in advance, we would ask for a trading freeze. So they're not trading the things in that portfolio because we're going to be doing that 25/50 math on a regular basis. The Friday before the launch, after close, we will do the 25/50 math once again. And let's say that NVIDIA position has become 26%. We will be working with our fund administrator and your custodian and you to say, okay, we're going to bring this back down to 25 so that it meets the requirements of the 25/50 math. And then on Monday, they own the new ETF either at, again, an averaged cost basis or the multiple cost basis based on the tax lots of the contributed securities.
I want to highlight something here, Evan, that I think is really important for most of the advisors that are contemplating this. And that is that as we were exploring this in the past, we've looked at potentially launching hedge funds and all kinds of different types of instruments. And it was really challenging because in some cases these things couldn't live at the custodian like Schwab or Fidelity. They required accreditation, they required separate paperwork. It was an unwieldy process. And so one of the reasons that we decided to pursue this, and we thought there would be an appetite for advisors, is that for your investors, this lives on the custodian. So it's not disruptive to an investor and their account. The assets are moving from positions that you decide you move into through doing exchange into an ETF on platform. So for billing or performance reporting or anything else like that, all these really important parts of an advisor that are kind of behind the scenes, it is sort of, in our opinion, minimally disruptive. So on platform, minimal paperwork, no like unwieldy stuff to make it all happen. So yeah.
And I recently had a conversation with an RIA who was really excited about this because he had a client who had a lot of assets on Schwab that he was not managing. And so he was able to talk to these folks and say, hey, we can do this 351 exchange, change the allocation that you've got, and then I will be able to manage it for you. So he was able to manage those assets and get paid on that. Now, the cost of the 351 exchange is basically nothing because it's just a transfer. We don't charge a fee. There may be a de minimis transfer charge at Schwab or your custodian, but nobody is charging a fee for this. It's just a transfer. Phil, do you want to get into the next steps?
Right. So one of the things about this that another highlight here is that if you are interested in this because of the time sensitive nature of it, you do need to, if you will, initiate. Because once the ETF has been launched, it just is an ETF. And although you can allocate to it, you can no longer move into it on a tax deferred basis. And so there is a necessity to get things done on time. Now, currently, we're looking at our first launch in early May. And so for that, then we need to see paperwork come in 1 month prior for our back office to make sure that everything is getting lined up. So that means early April. So really just, I think if you think there's an interest, just as Eben said, like message us on the Q&A or through the FPA or through the chat.
Or, we're the only two Philip Taves and Eben Burrs on LinkedIn.
Oh, right, right. There are a few Philip Tays. So then, and just say like, and we typically say like, what are you thinking? Send a sample first account, and we look at that, and especially if you've got a lot of accounts that look the same, then that can give you an idea of what that looks like. And then at the same time, we'll do a little deeper dive than just our basically the 1 minute we talked about the hedged equity approach, so you can get some visibility into that. In the case of hedged S&P, we do have a similar hedged equity S&P cap weighted ETF that has an over 5 year track record, so you can get a lot of really, I think, understanding of what that looks like.
Great.
Okay.
You want to go from here?
I do, Evan. I think so. We have a division of our firm that specializes in behavioral finance, and I published a book called The Behavioral Portfolio last year in March. And I'm happy, by the way, for anyone who wants a signed copy of that to send that out to anyone who's taken the time to attend this webinar today. But I'm just going to spend a little bit of time further framing the idea around hedged equity. Uh, Hedged equity has been increasingly adopted by the advisory community through instruments such as buffer ETFs, JP Morgan hedged equity now, the biggest mutual fund in that space is approaching a $20 billion level of AUM. It's not uncommon for us to find that an advisor has an allocation to hedged equity in their portfolio. But I'm preparing for a big presentation in late February right now, and one of the things I'm talking about is capitulation near market tops. It's exceedingly difficult to feel the need to protect portfolios when you've had market melt-ups as we've had over the last, as Evan was saying, 15 years, but especially last year when we really didn't see, once we got past Liberation Day, we really didn't see any major downturns. And if you saw a percent downturn, it was almost remedied by the end of the day. So, if you look here, this shows estimated Wall Street strategists and what the change in the S&P would be, what the actual change was, and then how wrong they were on an absolute basis, and on average wrong by 14%. Kaboom. But here's what's interesting is that never once did Wall Street strategists predict a loss, right? So it's very difficult to know currently, if you look at 2026, it's like 2025, an expectation of just north of 10% average prediction of Wall Street strategists. So really, it's almost impossible to predict that in advance. Evan, you want to go on to the next slide? Despite this lack of a sense of risk in the marketplace, there are a couple of things that historically have been pretty decent at predicting market losses. The most reliable would be the CAPE index. Bob Shiller's CAPE index. It's currently at 40.5. It's never been that high except in 99 and 2000 when it reached a high of 43.5. So we're almost there, Eben. But that's kind of scary. Forward earnings on the S&P right now are just north of, right around 22. That indicates a 0% return historically over the next 5 years. But this was probably the biggest whopper. It's the Buffett indicator that looks at total market cap relative to GDP. And wow, This peak was in the 99-2000 bubble near, around 145% market cap to GDP. This is before the Great Depression, and now we are at this moment actually north of 200% market cap to GDP. So, are we calling for a market downturn? Not exactly. We could see markets rally strongly. Sentiment indicators don't look like 99 to 2000. We didn't see that sort of euphoric market peak right now. So we're not really in the business of making market calls, but we are, pretty much constantly trying to assess the risk landscape. And if you're being realistic about the risk landscape, I think there are things that you would potentially be concerned about. So Evan, if you can move on to the next slide. The other thing too that we talk about a lot is that the downturns that we've experienced recently. This is the great financial crisis, and then on this peak here, and then you've got the one prior to that, which is the internet bubble burst. But look at the Great Depression and how significant that multi-year decline was. In my book, I spend time talking about that period, looking at a 60/40 portfolio, reaching the conclusion that it would be unnavigable for how advisors are building portfolios today. Evan, we can move on to the next slide. In the book, I propose a new behavioral construct, or a new construct for thinking about how to build portfolios. And what I suggest is that what one tries to do when building portfolios is match the right tail, the way you build portfolios, as much as possible. But to cut the left tail short from risks to inflation, deflation, or stagflation. Now, in order to do that, there's an assumed cost. So you might find that you're moving the mean returns a little bit left. In the book, I do an analysis of what this portfolio based on different scenarios would look like and how that might change the probability of success. And what I discover is that even though you're lowering the mean return, you might actually increase the probability of retirement success by adopting this approach. So how do you do that? And you can go to the next slide, Eben. The way that you accomplish that, or a way that you can accomplish that, is an example of a behavioral portfolio. So if you start with a 60/40 basic construct, and that's your risk profile, you stick with that. But you make two crucial changes. And the first is take a portion of your conventional equity allocation and put it into a hedged equity approach, something that it attempts to participate in market rises, but maybe with a less upcapture, but attempts to uncorrelate during market downturns. And so if we would go through a period like any of those declines that we saw, but it's in particular something like the Great Depression, the idea would be by putting enough to matter into hedged equity, you could significantly lower your down capture, lower your time to recovery in those portfolios. And frankly, from a behavioral perspective, point to something for investors that was specifically designed for that kind of a market by having that hedged equity allocation. Now, what's interesting, and we've had Eben has about 3 to 4 conversations a day with advisors looking to use this 351 exchange. I'm involved in fewer, but some of the conversations are with large multi-billion-dollar RIAs that are entirely conventional in their construct, and a lot of non-qualified high net worth investors. And so this process, you could just move ETFs into hedged equity tax deferred, would allow you to adopt this process in a tax deferred way. The other change that we recommend that investors and advisors make is to incorporate what we call an adaptive fixed income allocation, something that can move between maybe high yield or investment grade or very short duration T-bills to attempt to lessen losses from things like rising rates so that you can be more adaptive and address a wider range of fixed income scenarios. Eben, then you can go, wow, okay, disclosure. So that completes the information that we've had, that we prepared content. And I'm just going to mention maybe a couple more tidbits. As I said before, I'm very happy to have the conversation around the book. Please let us know if you want us to send out a signed copy of the book. We're hopeful to be in person at a Georgia event at some point soon. But I think with that, let's turn it over to any Q&A.
We don't have anything currently. Thanks so much, gentlemen. And I just did a last call for any questions. So if anybody's got anything, please submit that now. I want to thank you both, gentlemen. Thank you, Eben and Phil, for sharing such insightful and thought-provoking perspectives today. And a big thank you to everyone who joined us. We appreciate everyone's time and engagement.
Thanks very much for having us.
Thank you.
Yeah. And with not seeing anything else, gentlemen, thanks again. Everyone on the call, please be on the lookout for a follow-up email with a replay link, PowerPoint deck, and a brief survey. Your feedback helps us continue to deliver meaningful content. Thanks again, gentlemen. Everybody have a great afternoon.
Thank you. Take care. Bye-bye.